Hello everyone, Clifford Bennett, Chief Economist, ACY Securities. We saw some interesting data out in the US, but that's been completely swamped by the events of UBS acquiring Credit Suisse. Now here's some interesting facts for you. Friday closed, Credit Suisse closed on Friday worth $7.9 billion, which was after all the declines that we've seen over recent weeks. And on the weekend it was bought for $3 billion. So it halved, or 3.2, it halved over the weekend again. And only with the authorities guaranteeing a $100 billion special line of credit, not just for Credit Suisse, but for UBS as well, to keep UBS safe. So maybe this crisis isn't quite as over as a lot of people are thinking. Authorities also had to guarantee should there be any unexpected losses from the purchase of Credit Suisse. So this was a very interesting arrangement indeed between the two Swiss banks. I don't think this crisis is over. Every time we think this crisis is over, there's another one. It started out as SVB, and then it was Signature Bank got thrown in that weekend as well, and then that was okay, and then there was another 12 regional banks or something. I think that number's up to 19 now. Then there was First Republic all of a sudden, but it was resolved. But no, it isn't now. Now there's further discussions about whether First Republic can be rescued. Also, Janet Yellen, as I said last week, has restated and clarified, no, it isn't a guarantee of all deposits at all banks. It's only a guarantee of all deposits at banks she personally chooses it to be. And basically that means if you're not a Californian or New York bank, you could be in a lot of trouble. I have a feeling that over the course of this week, a lot of depositors at US regional, medium to small banks are going to wonder why their money is with that bank. So further contagion risk in particularly the regional banks of the United States is a high risk over the next 1, 2, 3 weeks, and not something to be shied away from or ignored. So this will weigh on equity markets in general, as well as bank stocks, as the week progresses. Initially, there is a rally in markets because everyone has taken a highly simplistic view that because the Fed won't be hiking interest rates, we can start buying stocks again. Or because authorities are throwing billions of dollars at banks to keep them afloat, saying, oh, it's not the taxpayers, but of course, in the end, it always is, that somehow the crisis is resolved. What's different this time around from the GFC is in the GFC, people go, oh, we think this, then this bank or organization is going to be in trouble. Whereas this time, it's like you picked up the newspaper if you're old school. You've picked up the newspaper and you've read, oh, there was a crisis at a bank. You didn't know there was a crisis at, but it's okay because it's already resolved. That's what authorities have been trying to do, particularly in the US. So it means we have no idea what's next, which means uncertainty, which means that banks are exposed to the downside by a loss of confidence or commitment from both investors and depositors. So it doesn't matter how much money the authorities throw at resolving a bank crisis or what they say about a bank in reassuring investors. That's great. But if it doesn't work because of this multiplying effect of all these bank crises, if it doesn't work to reassure and resolve any concerns depositors and investors have, that bank can still go under. If, investors pull back, share price falls, depositors withdraw, the bank can still go under. Any bank can still go under. No bank is too big to fail under those circumstances. So I think this banking crisis still has a long way to go. In fact, the crisis, for all we know, could perhaps only just be beginning. Now, referring to some of that economic data on Friday, industrial output in the United States was flat after a very small bounce back from a couple of months of contraction. So the industrial output situation in the US is dire. And that's still without the full impact of previous interest rate hikes having fed into the economy. So the outlook for the economy is not robust at all. It's a little bit tricky. And to add weight to that viewpoint is that US consumer confidence on Friday was again fell to the downside, and it was already range trading, if you like. Consumer confidence is range trading at crisis GFC levels, and it's starting to tick down again. So there are a lot of problems ahead, a lot of challenges ahead for the US economy, and I think it probably is time for the Federal Reserve to go on hold. And I've been saying that for a while, no more rate hikes because of SVB, and things have gotten much worse since then. A lot of people think there could be a 25-point rate hike, but I would still caution that it could be 0. But while that might provide, as we saw it first in Asia today, the idea of that, some upside to equity markets, I think they're going to run into a very serious wall of selling as really a lot of investors begin to tire. I mean, investor fatigue on all of this is growing, and investors at some point and at various stages decide this is just all too hard. I'm going to just step out of the market for a while and see what happens rather than get caught. And if enough investors start doing that, you are going to have a lot of downside still to come in US equity markets. So the US dollar is a very mixed bag because there could be such a panic that even though the problems are predominantly in the US, people bizarrely buy US dollars. So that's happened before, and that could happen again. So again, I'm kind of thinking go with the US dollar bounce here, even though there was some weakness initially in Asia, but be very quick to be a big long-term seller of the US dollar. I would say if we break the range of the last week to the downside for the US dollar. I hope this helps. Have a great day. It's going to be a very interesting week ahead. Thank you very much. Clifford Bennett, Chief Economist, ACY Securities.